Good morning, everyone, and welcome to today's webcast, State of the Economy Q&A for Investors. Before we begin, I'm going to go over a few housekeeping tips. For better viewing, close all other applications, turn up your speaker volume, and select the side-by-side view from the right top-hand corner. Here are the Webex controls available to you. Make sure you mute your share button to not active for the duration of the webcast. The share should be both grayed out. If not, your video will be seen. If you have a question, select Q&A under the More Options button. There, you will be able to ask our presenters any questions you may have by sending to all panelists. Any technical difficulties, please refresh your browser by clicking F5. If you are still experiencing issues, please feel free to use the question box and direct your question to the host. The material appearing in this presentation is for informational purposes only and should not be construed as advice of any kind, including without limitation, legal, accounting, or investment advice. Now I'll pass off to Matt to get us started. Matt, I can't hear you.
I don't think we have Matt. Hey, Amanda, can you hear me? Okay. I'm going to get started then. I think Matt's having some technical difficulties. So hi, I would just introduce myself. My name is Michelle Walker, and I'm the Director of Investment Strategy here at Moss Adams. Thanks for joining us today. We're going to do a brief overview of the economy and the markets, and then a review of fixed income, and then we're going to open it up for some questions. So starting with the first slide. So this chart on the left shows the multiple pullbacks of the S&P 500 since the financial crisis. The most significant is this recent drawdown you can see here on the right-hand side. On March 23rd, the market registered a decline of 35% from the all-time peak highs touched in February. This was the fastest turn from a bull to bear market in history. This rapid decline in the S&P 500 was accompanied by an extreme spike in what's called the volatility index, or the VIX. You can see here on this chart on the right that the VIX hit a record high of 82 in March, and that was a level that slightly exceeded what we saw in the financial crisis. If you aren't familiar, the VIX is a measure of the cost associated with buying put options or protection or insurance on equity securities. It's often called the fear or uncertainty index. One way to think about the VIX, it's like, say, trying to buy homeowner's insurance on your home when your neighbor's house is on fire. It gets expensive very quickly in the uncertainty. A spike in the VIX of this magnitude is often associated with a short-term and potentially longer-term bottom in stocks, and that's just what we saw. During the same time period, there was a rapid and significant response from the Federal Reserve and the U.S. government, supplying an unprecedented amount of monetary and fiscal stimulus, which brought calm to the markets. I promise this is the only time I'm going to say unprecedented. I know it's a very overused word right now, but as of late, it does apply to most everything. So since those lows on March 23rd, the market has shown incredible resilience, and the S&P 500 as of yesterday was actually slightly up on the year. The VIX is now trading in the mid-25s, which is still a little high by historical standards, but well off those highs we saw in March. So moving to the next slide, I'm just going to touch briefly on this vast amount of stimulus that we've seen entering the system. So far, the stimulus provided by the government exceeds $2.5 trillion. The CARES Act was signed into law in late March, and it included the Paycheck Protection Program, or the PPP. This loan program was rolled out for eligible small businesses to provide forgivable loans and to cover payroll and other costs. The goal of this program, of course, was and is to prevent job losses and small business failure, ideally getting small businesses through this challenging time. In addition to this government support, we also saw an extraordinary amount of support from the federal government in terms of monetary stimulus. In contrast to the financial crisis, however, the facilities that the Fed rolled out were rolled out immediately. And so they brought really quick normal function back to the credit markets, which was different than what we saw during the financial crisis. Since many of these facilities had already been created in 2008, the Federal Reserve really just had to dust them off and just reopen them. So these facilities are in place for the Fed to make open market purchases in U.S. Treasuries, agency-backed mortgages, commercial paper, investment grade, corporate credit, and municipal bonds, and in some cases does allow for the purchase of certain kinds of high yield securities. To date, about $2.8 trillion has been added to the Federal Reserve balance sheet, and by some estimates, this program could grow as high as $6 trillion. So moving along, this next chart shows all of the recessions and the S&P composite drawdown since 1928. Of note is the macro environment that was present during each recession. So in each recession preceding this one, there was one or more of the following macro elements heading into the downturn. A spike in a commodity price like oil or copper, extreme valuations like the tech bubble in 2000 or the housing bubble in 2008, or a more cyclical downturn caused by the Fed being overly tight with monetary policy. Coming into this crisis, we really didn't have any of these. Commodity prices had been really tame, relatively tame. The Federal Reserve had been quite accommodative, and valuations, though slightly elevated at the beginning of the year based on historical averages, really couldn't have been considered extreme. So this time, instead of a recession that's driven by, say, cyclical factors or asset bubbles, those are more typical. We're having this event-driven recession for which there's a lot less precedent. So moving on to the next slide. This is the chart of crude oil. It's worth mentioning because at the same time we saw this virus-induced economic slowdown that hurt the demand for oil, we also had a shock to the oil supply chain. So in early February, Russia and Saudi Arabia, known as OPEC+, broke their existing agreement with each other and embarked on a price war, pumping oil at any price. Not long after, of course, there was this extreme demand drop brought on by the stay-at-home mandates due to the coronavirus. This combination of supply and demand shock caused a deep decline in the price of crude oil that you can see here and put a lot of pressure on the energy sector. You may have seen in the news in late April that some oil contracts even traded at negative prices as producers scrambled to find storage for this vast amount of oversupply. Since then, however, OPEC Plus has come to some terms on supply cuts, at least through July, and crude prices have rallied as the markets are watching demand rebound, albeit slowly. So while the negative impact of lower oil prices is being felt in the U.S. oil patch, lower energy prices can provide a tailwind for consumers and for transportation-heavy industries as the economy recovers. So moving on to this next slide, there's some pretty grim news about the economic data. So in April, the unemployment rate came in at 14.7%, and that equates to a loss of all the jobs created since the financial crisis, albeit many of them may be temporary. However, the S&P jumped significantly late last week after the May report came in, and it showed a surprising add back of 2+ million jobs, with the unemployment rate retreating to 13.3%. Economists were expecting those numbers to be much, much worse. In fact, they were expecting a loss of 8 million jobs, and so the market saw this as super promising news. Forward-looking estimates out of the congressional budget are also a little bit dire, with the CBO looking for GDP to decline by 12% for the next quarter, equivalent to a 40% annualized drop. They're looking for a $13.7 trillion add to the national debt this year, and before factoring in the phase 4 stimulus deal, and that's rumored to be in the works. This would include the cost of the fiscal stimulus so far, plus impacts of the economic shutdown on federal revenues. This would bring the total federal debt to the highest level since World War II, placing it around 101% of GDP by the end of fiscal year 2020. This is a big number, no doubt. On the right side, the debt is being funded at historically low yield levels. So moving on to the next slide. So you can see why there is such a large expected decline in GDP for Q2. Consumption makes up about 70% of the US GDP, and during the height of the pandemic, retail sales and planned business CapEx spending, not surprisingly, slumped considerably. So the question, of course, we're being asked a lot is why the market has been going up when some of this data looks so bad. And the answer for now can be attributed to a couple of things, and they are forward-looking. One is the tremendous amount of stimulus and liquidity that's been added to the system. Like I mentioned before, it was quick and it was large. And I said I wouldn't use unprecedented, but it was unprecedented. Some of this optimism is also that the economy will actually recover more quickly than was originally expected. I just mentioned that the market found a lot of optimism in the May jobs report, which was much better than expected, actually showing people coming back into the workforce. And finally, some is due to the improvement in what is called high-frequency data. So Amanda, if you could flip one more time for me. Yeah, so on this slide, there's a graph showing the incremental improvement to what they call WEI, or the Weekly Economic Index. In March, the Fed created this index to measure high-frequency data to help assist in monitoring economic activity on a week-to-week basis, so we can actually really see incrementally how things are moving. It includes measures like same-store retail sales, consumer sentiment, unemployment claims, and things like steel production or fuel usage or electricity consumption. These high-frequency numbers are showing modest improvements as states reopen, albeit off of a very low base. Again, the market is looking for improvement and pricing that into its longer-term view. So while the data no doubt looks pretty awful, it is improving as the economy reopens. As I discussed, GDP is certain to take a significant hit in the coming quarter, and volatility will likely remain high until we know more about the scope of the virus, advances in treatment, and ideally a vaccine. And of course, how successful we are in reopening the economy and quickly getting people back to work. And while all these things will ultimately shape the course of the economic recovery, markets aren't always necessarily in sync with the current state of the real economy. Markets tend to be forward-looking, and they attempt to look beyond the current news and assess the longer-term impacts and opportunities over a longer time horizon. And at least for now, that forward look is discounting a lot of upbeat outcomes. So in a pretty stunning move, the S&P 500 just put in the biggest 50-day rally in history. And as I mentioned, it's a little bit up on the year. I won't read the whole list on this slide, but these are some of the many reasons cited for optimism. You can probably, glance through them yourselves, but that is, some of the things that the market is anticipating and pricing for a better tomorrow with a long-term time horizon. So that's our quick overview of the markets and the economy. I'm going to turn it over to George to talk about fixed income, and then we're going to open it up for questions.
Thank you, Michelle and Matt. I'm George Taylor. I'm the lead portfolio manager at Moss Adams. I've been here a long time. I have a co-portfolio manager. Her name's Heather Hagan, and the whole fixed income team is supported by our entire investment team and our advisors that serve clients directly. I broke up the talk in a couple different areas just to do a little bit more on the interest rates that Michelle went over somewhat. And then I wanted to, in the second part, I wanted to tell everybody, well, how do we approach fixed income portfolios in this type of markets? In fall of 2008, we had another financial crisis, and in some ways it was like today. We had a Fed chair at that point. His name was Ben Bernanke, and he lowered interest rates to zero, and that was the first time that it ever occurred. And they also started buying treasury bonds in the open market to support a really fragile and struggling economy. And this went on until 2015. And along the way, we had numerous struggles. We had, if you recall, the Meredith Whitney interview on 60 Minutes. You had the temper tantrum when Ben Bernanke decided he wasn't going to buy bonds anymore, which caused rates to rise. We had the U.S. credit markets that were downgraded by S&P and numerous budget negotiations that went on. Janet Yellen took over in 2014, and actually it was 15. She was elected at that point when Bernanke finished his second term. And she wanted to get the interest rates moving. And she started raising rates, but not till December of 2015. And for market watchers, the early part of 2016 was not good. One interest rate raise did not go well with the market. So there was not another raise until December of 2016. Then we have Jerome Powell. He's elected, and he starts in 2017. He wants to raise the rates. He wants to get these rates up. The economy's doing well, and 0 and 0.5 is no longer acceptable to him. He starts raising them 0.25 almost every meeting, all the way up to December of 2018, and we're up to 2.5. The market is just not happy. We had stocks that declined. Interest rates were in their highest point at that point in that cycle. And then they decide they're going to hold off. And so 2018 into 19, we hold off. Then in the summer, he decides July through September area, we cut 3 times an hour at 150, and the market begins to roar through the rest of 2019. Interest rates are also falling at that time. Then we get this COVID-19 that starts in late February, early March. Immediately, Jerome Powell cuts rates once, and then on a Sunday, cuts them all the way to 0 again. So we're back at the same place we were in 2008. We're in the zero money, or Fed funds rates. And that means 0 on your money market funds, nothing on CDs, short-term folks that like to invest for safety and the short end do not get any interest. You can't make anything, 0.01. So the thing that we do is my second part of the talk is how do we do this? Now we did it in 2008. We have to do it again. This time we have a track record moving from 2008 with a lot of clients. But we use laddered maturities. After all, bonds, fixed income, they're a loan. You're loaning money to a government, corporate, or a municipality. And what we want to do is we want to get our interest and we want our money back at a certain time frame. There's not too many other asset classes. Maybe a real estate contract or something like that ends with maturity. So what we do is we want to invest in the safest parts. Here's an example on this slide. On this part over here, we're investing as a part of the market where you want the lowest amount of risk. Like a 40, 60 stock portfolio, it's going to give you the smooth ride. Fixed income is a core bond portfolio for us here. Treasuries, municipal bonds, corporate, good quality corporate, which is companies that you would recognize. And these provide stability and income for your portfolio in volatile times. This slide here just shows one of the indexes. We want to invest in a lot of different maturities. 1 to 3 years, 3 to 5. We want to invest even 10 years. With municipal bonds, we might want to go out even 15 years. We want a lot of different maturities, and that's called laddering. We do that so there's always bonds coming due, so in case an opportunity comes up, maybe rates rise. Also, people need money for things. Things change, so they have money coming due. The other areas are in the core area, 5 years, out to 15 years. You have to have a longer term maturities in your portfolio so you can have that steady income to fund retirement and such. In the next slide, we're looking at the idea that the safety part. Look at the municipal bonds. Even in the worst times, and we had some of that, in March, they still, on most cases, are the safest of bonds. Corporates, not as much, but treasuries, very good as well. These are the areas that we want to use. Next slide would be the credit quality. Now, municipal bonds, even though we have some budget problems right now, states and cities have been closed down, we still in the past, even in 2008 and that time period, very few defaults in municipal bonds especially. And we want to have municipal bonds because we really like the tax-free nature. You invest in a community, your own community perhaps, your own state bonds. Maybe you get a state tax deduction as well. And you're participating in your own community. In return, you get tax-free income. And our clients, they like that tax-free income. We usually use the corporate and the treasuries in the more early maturities because they're usually more liquid. And they also provide the idea that if things come up, you can sell them easier and move forward with that. So the idea of a diversified portfolio, treasuries, corporates, municipals, laddered out in a portfolio. At Moss Adams, we manage those for you on a regular basis, and it just is the best for safety. You can use the equity portfolio for your risk side, but this part we like to have safety. Now, we're going to have some questions, and I want to turn over to Amanda. Actually, Matthew might want to be able to say something here and ask the questions. Matt?
You know, I think we did, I think Matt is having some technical difficulty, so I'm going to start with, I see the first question coming through. So the first question is, with all the stimulus being injected in the system, and we do get this a question a lot, is there, you know, a chance for inflation, or what do we think about the probability of inflation? So the way I would answer that is, you know, right now we're clearly in a deflationary environment. Demand is weak, commodity prices are soft, and the wage pressures we've been seeing the last couple of years are going to be abating with this, you know, levels of unemployment that we're seeing. In addition, the stimulus that's been provided, you know, being provided right now, at least so far, is either to support the normal function of the credit markets or just to simply carry households and small businesses through to the other side of this economic event. So not necessarily stimulating a ton of consumption right now. One reason to expect inflation to stay low for some time is due to precautionary saving on the part of consumers and low investment on the part of businesses until a normal level of confidence is restored. And we are seeing this uptick in savings. Of course, a longer-term case for inflation can be made, and that's like, for example, if we were to see a lot of supply destruction through this current period due to business consolidations or failures. Examples could be in the oil patch or retail sectors, or perhaps, and you know, we certainly hope not, but a loss of a major airline. And this followed by a quick rebound in demand, while at the same time borrowing rates are very low and there's a lot of excess liquidity sloshing around in the system, chasing more goods with less competition. I mean, that could be a recipe for inflation. So economists are pretty fairly split on the outlooks for inflation. Clearly in the long term, it's not going to be a problem. Many economists do view the longer term as being more risky for inflation. However, you may recall that inflation expectations were also high coming out of the 2008 crisis, as we also had zero interest rates then, with a lot of accommodation and liquidity provided by central banks globally. But the inflation really never materialized, and a lot of that was due to a massive amount of productivity advances that we saw brought on by technology.
Okay, the next question's for fixed income. And the question is, where do you think interest rates are going now that the Fed has lowered rates to zero? Well, last time, like I mentioned in the talk, we didn't do anything for 5 years. Now, this recession is much different. The markets have recovered very quickly, whereas it took 6 months to reach the bottom last time. So I think we're going to have, and this is coming from Jerome Powell this time, he thinks maybe 2023 we could have rates that would be zero. So the only thing that would change that would be is if the economy really started moving quicker, they may pull back their buying activity in the marketplace, and that would cause rates to perhaps move higher in with longer-term securities. But short-term securities are probably going to stay very low for at least 24 or 36 months. Go ahead,
Thanks,
Michelle.
George. Hey, yeah, we've got another question coming in, and it says, Michelle, we saw when you showed the April unemployment report that it looks like wage growth jumped. Is that right? That's a great catch. Good question. So at first glance, that was a surprise. It did look like wage growth jumped by 7.7%. But then digging into that further, the cause for that was actually that the majority of the jobs lost in April were lower paying jobs. And so what that number was actually reflecting was the average wages for the people who were still employed. So it got arbitrarily bumped up because most of the losses were in the lower paying wage sector of the market. So actually, in fact, a lot of the people who remained employed actually did take a pay cut. So that one economic statistic did look a little bit confusing.
Excellent. Next question comes in for fixed income. George, what do you think of high yield bonds? Well, we have high yield bonds in the corporate area. We do have high yield bonds in municipals as well. They belong in a portfolio, a very diversified portfolio, and probably a smaller percentage. In our laddered maturities, we would not use high yield, but we would probably hire an additional manager to do that for clients. But high yield can have opportunities. And right now, though, like Michelle talked about, what the Fed is doing, they're buying into these high yield markets, corporates. So yields are a little suppressed right now. And remember that the Federal Reserve is not guaranteeing solvency. They're just helping trading and liquidity of the markets. So any high yield bonds, while they might give you additional yield, smaller percentage would be best. Michelle?
Thanks, George. Okay, we got another question. Asking about oil, wondering how is it possible for oil contracts to trade negative? Yeah, so that did actually throw the market for quite a loop. We've never seen that before. It was really due to this extraordinary extreme imbalance that we saw, with the economy really shut down, and then this huge supply of oil based on this breakup of the OPEC agreement. So how that worked is at the end of April, the actual true energy participants in the markets, all their storage facilities were full. So they couldn't really take any more delivery of oil. But at the same time, there were some retail owners of these futures contracts who got, really offsides. So the thing that happens with a retail investor who owns a contract is they don't have any ability to take delivery of the actual commodity upon expiration of the contract. So just prior to the delivery date, they had to sell their futures contracts at a negative price, which means they basically had to pay someone to take the oil from them. So it was one of those crazy things that we've never seen before, but it has righted itself. As I mentioned, OPEC Plus has come to some terms on supply cuts, and we are starting to see demand tick up, and so it has resolved itself. But I will just say there was one main retail fund out there where this happened, and the ticker is USO. And again, it's like a fund that bets on the price of oil prices, and it was just this kind of dislocation that happened in this extreme imbalanced environment.
Okay, another fixed income question. It's kind of like a question on portfolio construction. And it reads, George, when you ladder maturities, do you put the same amount in each maturity, like you mentioned, from 2020 to 2035? And the answer is no. Usually we like to have an average maturity between 5 and 10 years. And we like to put the lowest amount usually in the short term and the lowest amount of laddered percentage in the longer term. And most of it is in the middle. We find that that's the core where interest rates will be most beneficial to us, whether they rise or go down, because we'll get the most income for the amount of risk that we're taking. So we kind of have a point where we call the short-term opportunity, middle core, then we call the longer term, we call them heavy lifters, because you got to have those longer-term bonds in there to give you that income that you need. And that's why we do call these programs long-term income plans, because you do own some longer-term bonds. Michelle?
Yeah. So we have time for about one more question. It is coming in here. It says, can you talk about the sector rotation that's been going on in the markets? Yeah, so as I mentioned, during the overview, we hit at least the current bottom in the stock market on March 23rd. Initially, the rebound in stocks came in the technology sector, and that led the way off the bottom. Not surprisingly, as investors were looking for well-capitalized companies who could perform well in the stay-home economy that we were, finding ourselves living in. So a lot of the companies that did well were primarily companies that could facilitate a quick move to this at-home digital lifestyle that we were experiencing. But as of late, however, with a lot more of the positivity coming into the markets, we've really seen a lot of improvement in the hard-hit sectors like travel, leisure, hospitality, energy, and retail. All of those have recovered significantly off the bottom as people are becoming more optimistic that out in the future, the economy will return at some point to normal, regular levels. So that is the last question that we have time for. I think we did get a few more questions that we haven't had time to address, but we will be reaching out to answer those personally. And I do think we lost Matt, unfortunately, but we just want to wrap this up by saying we are here to answer any questions. You can see on the screen there the information for George, myself, and Matt. And of course, as many of you have your advisors here at Moss Adams, please reach out to them as well if you have any questions. We are happy to help. So thanks again for sharing your morning with us. We appreciate your time.
Thanks, everyone.
Thanks, everyone.